Here's our quick blueprint today. We're hitting core concepts, the 3 factors of depreciation, crunching the numbers with different methods, comparing tangible and intangible assets, and finally, a quick quiz to test yourself.
All right, Section 1, Core Concepts, the Basics.
Okay, so you really can't calculate what you don't fully understand, right? Let's lay the foundation. Depreciation is simply allocating a fixed assets cost over the actual accounting periods it's utilized. Now, a lot of students think depreciation is about finding the current market value of an asset. Actually, scratch that, it is definitely not. It's purely an accounting process of matching expenses to the revenues they help generate, accounting for wear, tear, and obsolescence over time.
And this idea transitions perfectly over to non-physical assets too. Amortization is literally the exact same underlying concept, just applied to intangibles. You're still systematically allocating a depreciable amount over a useful life, but you're doing it for things like rights, patents, or software, instead of, say, a giant piece of heavy machinery.
Moving right along to Section 2, the 3 factors of depreciation.
So before you even touch a calculator, you've got to extract the right data from your exam prompt. There are 3 absolutely crucial variables you must identify. First, the total cost of the asset. Second, its estimated useful life, like how long the business actually expects to use it. And third, the estimated residual or scrap value, basically what it's worth at the very end. If you miss even one of these in a word problem, your whole calculation is going to be way off.
Now for Section 3, Crunching the Numbers, Methods.
Okay, time for the heavy lifting. Let's look at how to actually calculate these allocations step by step. First up is the production units method. This one is super practical for manufacturing businesses because it ties the expense directly to machine usage. Instead of asking, how many years will this last? It asks, how many units can this machine pump out before it totally breaks down?
Here's your step-by-step setup. You always want to find your depreciable base first by subtracting the residual value from the initial cost. Never calculate depreciation on the raw cost if a scrap value is staring you in the face. Once you have that base, you apply your production ratio, which is just the units produced this year divided by the total estimated lifetime units.
Now, mapping this out year over year is absolutely crucial so the numbers don't just become a confusing word salad on your test. Take a look at this calculation. 20 lock minus 2 lock gives you an 18 lock depreciable base. By taking the 150,000 units produced in a given period and multiplying it by the per unit rate from that base, you get precise, usage-based figures for every single year. Seriously, structure your scratch paper exactly like this table during the exam and you won't make a silly math error.
All right, another complex one you'll for sure be tested on is the sum of years of digits method. This is an accelerated depreciation method. All that means is it recognizes way more expense in the early years of an asset's life and much less in the later years. To ace this, just remember the denominator is the sum of all years. So if the life is 10 years, you literally add 10 plus 9 plus 8 all the way down to 1. That gives you 55. Your numerator is the years of life remaining, including the current year. So in year 1 of a 10-year asset, the fraction is 10 over 55. You multiply that fraction by your depreciable base. It's a heavy hit early on, which perfectly matches assets that lose their value really quickly. I highly recommend pausing and taking a screenshot of this summary table. It perfectly compares the core methods and their unique characteristics, which is pure gold for multiple choice questions. If they ask for equal amounts, it's straight line. If they mention a fixed percentage on a shrinking balance, that's written down value, also known as the reducing balance method. Knowing these distinct characteristics will save you so much time on a timed test.
Let's shift gears to Section 4, Tangible versus Intangible Assets.
We really need to clarify a distinction here, because professors absolutely love to test this to check your grasp of accounting terminology. Notice the exact differences here. Physical items, stuff with real substance, get depreciated based on their physical, useful life. On the flip side, non-physical items, like a patent or software, get amortized. And here is a huge pro tip for your exam. Accounting rules generally presume the useful life of an intangible asset won't exceed 10 years, unless there is hard evidence to the contrary. Definitely keep that 10-year rule in your back pocket.
Okay, Section 5, quick quiz. Test yourself. Let's see what you retained.
All right, it's active recall time. Think back to our comparison of physical and non-physical items from just a moment ago. If an exam question doesn't explicitly give you the lifespan of a newly developed software or patent, what is the presumed ceiling you're allowed to amortize it over? If you remembered 10 years, you hit the nail on the head, and you are totally ready for that trick question. Always default to 10 years unless the word problem specifically hands you concrete evidence of a longer economic life.
Okay, here's your final test question, and this one really relies on understanding the math conceptually. Under which depreciation method can the value of an asset never be completely extinguished? Like which mathematical method always leaves a trace balance, meaning the book value literally never hits true zero?
It's the reducing balance or written down value method. Because it takes a fixed percentage of a constantly diminishing balance, the WDV method never actually hits zero. You're always just taking a fraction of a fraction. This is a super sharp contrast to the straight line method, which can absolutely write an asset all the way down to a complete zero if it has no scrap value.
So now that you have the real blueprint to pass your exam, I want to leave you with this thought. How much does hidden wear and tear truly impact the bottom line of the businesses you interact with every single day? You know, depreciation isn't just an exam hurdle. It's this invisible force constantly reshaping a company's true financial health. Keep that in mind, study your tables, and go totally crush that exam.